back and relax. You're listening to episode 261 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. My guest for this episode was Chip Roame, founder of Tiburon. Now, Chip started it quite a while back, I think 25 years ago. He's been running the Tiburon conferences and the Tiburon advisors. It's quite the company, quite the organization. I've been a member for a couple of years, and I'm kicking myself for not joining sooner. So I was pretty excited to have Chip on the program. And we spoke about, of course, the upcoming Tiburon CEO Summit at the end of this month in San Francisco, as well as Chip's keynote, which is very exciting. Everyone's very pumped up when they get to the conference to hear Chip's keynote. It goes on for about an hour and a half. And as we talked about in this episode, it's hundreds of slides. He goes and he wails through it. It goes really fast, lots of information dump. Your brain is just mush at the end. But it's a lot of great information to take back. And we use it a lot here at Ezra Group. We use a lot of Tiburon research in our work. Now, we spoke about three of the areas that Chip is going to cover in the keynote. There were, I think, 5 or 6 total. We can only hit 3 of them. We hit alternative investments. We hit M&A and IPOs in the wealth tech space and wealth management space. And we talked about the current state of wealth tech. So those 3 are the areas we spoke about. And speaking about the current state of wealth tech, here at Ezra Group, we're experts on everything wealth tech, including CRM, portfolio management, trading rebalancing, performance reporting, just to name a few. Now, when we start working with an RIA or broker-dealer, the first thing we do is comprehensive tech stack assessment. Now, this provides a top-to-bottom view of all systems or processes, and it's a critical part of the firm's growth plan since the tech stack is really the foundation for building towards the future. So if you'd like to see your tech stack converted from a liability into an asset, you need to run, not walk, to our website, EzraGroup.com, and click on the golden Contact Us button at the top of the homepage. The experienced team at Ezra Group will conduct a detailed tech stack assessment for you, delivering targeted recommendations that will optimize your existing software platforms, or we can run an RFP process and help you select and then implement a new solution to help take your firm to the next level. You can schedule a free consultation by going to EzraGroup.com. And a few housekeeping tasks before we continue. Please subscribe to the show wherever you listen to podcasts so you don't miss an episode. Check out our sponsors, the Invest in Others Charitable Foundation. You can find them at investinothers.org. And now, let's kick this thing off. And here we go with my next guest. I'm happy to introduce Chip Roame, Managing Principal of Tiburon Strategic Advisors and the Tiburon CEO Summit, which I and everyone else just calls Tiburon. Welcome, Chip.
Thank you. Thanks for having me, Craig.
I'm so glad to be here. You're here. We had a tough time scheduling between our both of our travels and businesses. There's too much going on these days. Where are you calling in from?
I am actually at home. I'm at my office, but in California.
Yeah, and you're lucky you guys don't have the weather that's going on in Florida now.
No, Florida's about to get pummeled again for a second time. Doesn't look good.
Yeah, our CEO of Ezra Group lives in St. Petersburg, right in the path of the storm, and she bugged out yesterday to Tallahassee.
Yeah, it makes me think earthquakes are okay in California. Huh?
Yeah, earthquakes, mudslides, wildfires, not so bad. It's all relative, I guess. Cool. So, Chip, let's jump in. Could you please give anyone listening to the program the 30-second elevator pitch for Tiburon?
Sure. So the broader company, Tiburon Strategic Advisors, has been around a little over 25 years. I'd say at the core, we focus on the wealth and investment management industry, and obviously including the wealth tech that underlies that. But broadly, we think about wealth and investment management, everything on wealth from discount brokerage up to family offices, and in investment management, everything from mutual funds up to private equity funds. So all wealth and investment management and wealth tech. started kind of doing classic consulting projects. I'm a McKinsey consultant by background. Today, more of a membership organization. About 650 companies are Tiburon members today. Come to the Tiburon CEO Summits, watch Tiburon webinars, read Tiburon written research. So kind of a think tank or a research shop in the wealth and investment management industry.
And I have to say I'm a big fan and a member. It's incredibly valuable, and I'm really happy you could take the time to talk to us here today. And in advance of the upcoming Tiburon CEO Summit, and there's two a year, one in May, one in October, and the October one is always in San Francisco. So we're all booked and ready to go for that conference. Let's just dive in. Can you give us what are the key trends? So you're going to give a little bit of a peek behind the curtain for anyone who's attending or even wants to attend. What's the five key trends you're going to be talking about in your keynote at the conference?
Yep, that's a fair question. So we're about 3 weeks out from we'll be Tiburon CEO Summit number 47. So we're pretty far developed on the content right now. I'd say the five biggest things we'll talk about. One, we'll talk about target markets. A few things, the mass affluent are important. The wealth transfer people talk about, the importance of women clients, things like that will be in the category of target markets. In the product and service category, ETFs continue to take over the world. Active ETFs have some pros and cons. Direct indexing is hot. Alternatives is super important. Registered products in the alternative space. ESG maybe or maybe not, but a bunch of things around products there. Third, around channels. So discount brokerage firms continue to do quite well. In the wires, Morgan Stanley continues to do well. Not so much all the firms, but Morgan Stanley's doing well. In the independent advisor world, a little bit shift to the RIA portion of the independent advisor world. That's a third category. Fourth category will be kind of more the tactical issues. Marketing and lead gen is kind of a big issue in the industry right now. Industry's only growing about 3% per year right now. So marketing and lead gen comes to the forefront there. Some technology underlying some of that's important as well. And then lastly, kind of how the structure of the industry is evolving. And what we mean by that is who's investing venture capital into the space, what M&A deals are happening, are IPOs happening? So you think about industry structure broadly. So I'd say those are the five broad categories: that who the target market is, how the products are changing, how the channels are changing, how the tactics are changing, and then how the industry structure is changing.
And for anyone who hasn't been to one of these summits, the highlight is Chip's keynote. And how many slides are in that? Is like 500 slides or 300 slides? It's crazy.
So in the draft, again, we're 3 weeks out, Craig. 3 weeks out, I have 258 slides in my draft today. So we'll see if I make that shorter or longer, but it's 258 right now.
Yeah, just for a reference, the May conference slides I have in front of me, it's 273.
Ooh, look at that. Wow, I'm consistent.
You are consistent, yeah. So it's like I study it like the Torah when I get back from the conference. I'm like, oh, what did I miss? All right, so I want to dive into a couple of things that I think will be interesting to our audience. This is the WealthTech Today podcast. Let's talk about wealth tech. So under evolving business tactics, what's about in terms of the comprehensive wealth management platforms? What are you seeing?
Yeah, so I think there's a couple things to understand here in tech. So number one, there's really three fundamentally maybe higher importance pieces of tech when you ask advisors. So pretty much any survey repeats the same three things. The CRM system, the financial planning system, and the portfolio accounting system are the big three, right? There's other things. There's, risk systems and rebalancing systems and billing systems and all kinds of other things. But the big three, CRM, financial planning, and portfolio accounting. And what you've seen over recent years is the portfolio accounting systems have been the acquirers. They've been buying up some of the, let's call them the hot single point solutions. So, a decent example would be Redtail getting snapped up by Orion, or Money Guide Pro getting snapped up by Envestnet, right? So if an entrepreneur today builds a fancy CRM or a fancy financial planning software, there's a decent chance it gets acquired by a broader platform. So I'd say that the managed account platforms are probably coming to dominate the space and owning the other single point solutions.
Yeah, we are seeing a lot of that, but do you see that as, will that continue? Because they can only buy so much and there's only so many out there. And is that going to be successful? Do you see that as are they just trying to keep up with the Joneses, or is that something that's going to be successful long term? I point to InvestNet. There's been a lot of rumors, and I've been spreading some of them that Bain might unravel InvestNet and sell off Money Guide or sell off Tamarack.
Yeah, interesting question. I think at the core, I'm a corporate finance person or a strategic consultant person. So I think you have to think about shareholder value at the end of the day. If we take the InvestNet case specifically that you're referencing, InvestNet probably doesn't need to own Yodlee. That's pretty clear to me. That probably could have been a rental. That could have been a purchase data. I'd say Money Guide Pro is pretty well linked in. I think you need to own that. I think that's part of the front end. And then Tamarack is really more of a technology for the RIA market. Core InvestNet's more of a technology for the independent broker-dealer market. So I think people get not Craig, not informed consultants like you, but people generally, I think, gloss over the differences. Orion's primarily a technology for RIAs. Tamarack's primarily a technology for RIAs. Core InvestNet's primarily technology for independent reps. Money Guide Pro or even eMoney that Fidelity owns are great front ends to those managed account platforms. So if you want my honest prediction on InvestNet and Bain's ownership, I bet they sell Yodlee, but they keep Money Guide Pro.
There you go. We'll find out. You've heard it here first. Looking at the big three technology components, CRM, financial planning, and portfolio management, do you see a time where there's going to be more M&A or more companies leaving the space and that there are too many? I wrote an article now, I think 7 years ago, that said 50 portfolio management systems can't all survive.
Yeah.
Right?
It's
so
interesting. Yeah, thanks. Sorry, I didn't mean to cut you off, but I think it's interesting because it's the same trend in numerous different other industries. You always have acquisitions, but you have more entrepreneurs than you do acquisitions. So every time something gets snapped up. So InvestCloud enters the market and snaps up this old security APL that became Tegra 118. Those things go away. But then later, some other portfolio accounting system comes, or Redtail gets snapped up, and here comes WealthBox or whatever. There's always a new entrepreneur coming behind you. So I think that's true in lots of industries. Like, we're talking about wealth tech today, but wealth management's the exact same thing. For instance, you have this huge consolidation of RIAs going on, and everyone talks about that. But the number of RIAs is going up, not down, because there's more new entrants than there are consolidations. So I think the same is true in tech. You can always watch them gobble them up, but you always see a new entrepreneur out there following behind.
Yeah, I was thinking more that there's only so much market share, and there's only so many portfolio management platforms or firms that need portfolio management, and it's not something that's changed very often. That's something we do. It's one of our core services is RFPs and replacing portfolio management platforms, and it's very sticky.
Yep.
So it's very difficult to convert. We just finished for a broker deal. It took us a year to get them converted from one platform to another. So while there's more companies coming into the space, do you see them? Would you say, well, don't do that because there's not enough there's not enough revenue for any more portfolio management platforms? Or do you see that not being the case?
Well, yes and no. I think the revenues are going up. So I think the amount of available TAM or total addressable market in portfolio accounting is actually fairly substantial. And as you know, portfolio accounting systems are also used by the money manager side of the equation. So not just the wealth management side of the equation. So that's a pretty big market and a growing market. I think the risk there is as you add on additional componentry, so as you add on a financial planning software, a CRM or whatever, you probably don't need to add on 2 or 3 of those things. You want to integrate one of those things. So we'll end up with these very large, complex platforms out there, and then they become amazingly sticky. And so you can enter as the new guy, but getting people to move to the new guy will be very, very difficult. So I think that's worth keeping in mind. I think every new entrepreneur comes along, says, "Well, look at my technology is better than your technology." That actually may be true. Let's even give them that one. It doesn't mean anyone's going to move to your technology, and I think that's the key there, right? So as these big monolith platforms get out there, they have pretty high retention rates. It's pretty hard to pull someone away.
My favorite quote is inertia is a very powerful force in our business.
I think that's true. Yeah. And then you have these like new venture backed firms. So whether they're like a robo advisor, like a Wealthfront or a Betterment or someone, or a more full service firm like a Facet or a Savvy or someone like that, and they have a lot of capital, they may use a new technology platform. They may build their own, or they may use a new one. But to think that you're going to get, Merrill Lynch, a wirehouse like Merrill Lynch, or a regional like Janney Montgomery Scott, or a independent BD like LPL, or a large RIA like Edelman Financial Engines to scrap their platform and move to a new platform, that's a very aggressive view of the industry. I don't think a lot of that happens.
Although just to be clear, Edelman did switch within the last 5 years, right? So it's not unheard of for firms that
Yep.
size to switch. It's just they don't
Yep.
do it very often.
Yep. I happen to be a board member of Edelman Financial Engines. I will tell you, we switched twice actually. So
There you go. Right. And you brought up Savvy and other firms. So I'm always interested when firms are building their own, when there's already 47 out there.
yep.
Do you see that as being a trend that more firms, because of technology becoming easier to write, especially with AI, you can have it write the code for you. Do you see more firms building their own technology rather than buying renting solutions?
Yeah, I do at two ends. So use Savvy as your example, and I think that's one of the categories. So these new venture-backed firms want to own the UX. They want it to be their proprietary view, their proprietary presentation, and so they're more likely builders than they are buyers. I would agree there. And then secondly, I think because of the aggregation of the RIA market, these firms that are now becoming hundreds of billions of dollars, so a Cap Trust and Edelman Financial Engines, a Creative Planning, et cetera, they then get to a point where they want to own their UX. They don't want to rely on the standard off-the-shelf platform. So both the Facet and Savvies who come into the market well backed with capital, and then these firms that have grown up and they've pieced together a bunch of different systems. In both cases, they ultimately get to a point where they want to own the UX. They want to own the user experience. And I think, therefore, you see two areas where they build their own.
Because we're seeing that a lot more. We're doing a lot more. We spend a lot of time with integrations, and we're seeing a lot more capabilities there, and a lot more firms expanding integrations. We do integration research, and we're seeing the integrations growing, and the capabilities of integrations are being able to provide more value across different applications.
Yep.
Along the lines of technology, under category 4, you also have artificial intelligence, which everyone has to talk about at every conference. But what specifically can you share that you're seeing around AI in the wealth tech space?
I think AI is a fancy buzzword, as you say, as you kind of joke about. I think everyone drops it in. A lot of what AI does today has been around longer than people seem to remember. I sometimes see things like call routing being considered AI or something like that, or now note taking is considered AI. If we run an audio like this and we have a note taker, that somehow that's AI all of a sudden, or whatever. So I think we're kind of shoving a lot of stuff under this phrase called AI right now. Our basic efforts like note taking or drafting, marketing communications or things like that happening. Absolutely, that type of stuff is happening. Are a bunch of financial advisors going to be displaced because of AI? No, I don't think that's coming. So, and again, I almost feel like we're having the same conversation we had when the phrase robo advisors came out. No, every advisor is going to be put out of business. No, that's not going to happen. And AI and the exact same thing is not going to put a bunch of advisors out of business. It's going to make a bunch of advisors a lot more efficient, is what it's going to do.
Well, let me pitch you on something. Because AI is a little different than the robo trend was just taking all the same technology that any advisory has and just putting a front end on it.
Yep.
But the front end still had severe limitations. It was better for account opening, and that really helped a lot with digital account opening we didn't have before. That came from the robos. But with the AI and generative AI specifically, and the chatbots, they can learn and communicate more like a human can. So where we see these chatbots pass the bar, and why can't they pass the CFP exam? And why can't they be able to provide just as much information that you could call your advisor for? So theoretically, seems to be a bigger threat than the robo advisors.
I think it's a fair comment. Yes. Although, again, I'm at a core, I'm a research guy, and I have forever typed into Google search engine, things like what are the top 10 trends in wealth management, or what are Google answers that question. Google has always answered that question. It's not a new thing to get an answer to that
Yeah,
today. So I think again, is that all really new, or is some of this packaging? We'll see. I mean, that's a great capability, but we've been doing it a long time. So, yeah.
indeed. Okay, so looking at the time, I want to move to the next
Yep.
category, which is evolving industry structures, but still focusing on the wealth tech. I
Yep.
know at Ezra Group, we do some work with PE firms. We do evaluations of wealth tech firms before they're acquired, evaluations of the tech stacks for RIAs. But what are you seeing when it comes to M&A and the structure behind these?
Yeah. So I guess the way I would think about it, almost in order, is if you take the category of wealth tech, is how much venture capital is flowing in, and then into what? How much M&A is happening, and what types of firms are merging? And then are any of them going public? Is there an IPO market for them?
Mhm.
So let's go through those three, stages of life of a wealth tech company, right? So you probably, I mean, if you look at the Kitsis and other lists of wealth tech companies, there's somewhere around 500 or 550 wealth tech companies out there, right? So let's just take that. The Tiburon number, we'd say there's 520 of them, if that's a helpful number for people. So we think there's 520 wealth tech companies. Last year, we're recording this in October of 2024. Last year, the year 2023, there were 315 additional venture capital investments into wealth tech companies. So remember, the base is 520 companies, and last year we had 315 more venture investments. Some of those were into the companies that already exist. Some of them were supporting new companies, but that's a lot of investments. So if you think back through, you think through that over time, that's a big number. That's a big number relative to almost any industry. So
Is that
big, big.
last year alone?
That was last year alone. Last
Just
year,
2023.
yeah. So think about, 50 weeks in a year. Think about six venture investments every week, six every week, right? So if you go back over time, the biggest wealth tech venture capital raisers, Plaid would be way up there. The aggregation engine, over 700 million bucks. Both ICAP and Case, building those alternative platforms, are at
Mhm.
600 or 700 million each. Adapar would be up there at 500 or 600 million. Yield Street, Altruist, recently been climbing that. These firms have all raised hundreds of millions of dollars. So
Mhm.
300 and some odd venture capital investments last year. So very active venture capital market for wealth tech. So that's question one. Question two is M&A. Last year, there were 188 M&A transactions, right? So in wealth tech alone, 188. So that's three per week, right? 188 transactions last year. Again, you can go back through some of the largest ones. So like Motive has been a big buyer, the private equity firm. They bought FNZ Group. They bought numerous things along those lines.
Invest Cloud.
Yeah, yeah, exactly. Yep. SS&C, you can go back even in the old days when they bought Advent or someone like that, or State Street bought Charles River, or
Mhm.
BlackRock investing in Envestnet, or now Bain having bought Envestnet. These are all wealth tech M&A transactions. So a lot of those going on. And then the one that's not happening is wealth tech IPOs. So there were literally zero last year. There were zero the year before. So in the years 2022 and 2023, there were no wealth tech IPOs. So if you actually go back looking for a big IPO, it's hard to find a big IPO in wealth tech, right? You'd find things like Asset Mark going public, but they raised about $300 million. Or Envestnet went public. I was actually on their board at the time. They raised around $100 million. These
Yeah,
are
tiny.
pretty small IPOs and pretty long ago. So
Mm.
I'd say the wealth tech market does not have a big history of IPOs here. It has a lot of venture investing, a lot of M&A activity, but the takeout seems to be the M&A, not the IPO.
Mm.
So you'll see Envestnet come back public at some point. Orion might go public at some point. I mean, I know InvestCloud's had a few struggles, but they had announced they were thinking about an IPO at one point. So, I mean, you'll see these firms come public again at some point. But the reality has been a lot of venture investing and a lot of M&A transactions and not a lot of IPOs in wealth tech.
Do you think that's because of the structure of our market or the difficulty in IPOing or the heavy regulatory burden that you that you take on yourself when you become a publicly traded company?
Yeah, so let's take those in reverse order. I think because there's so much private equity chasing both the wealth tech and the wealth management markets, there's so much private equity chasing, and they generally will pay multiples that are high or higher than the public market, right? So why go public when some private equity firm will give you the money at the same price or a better price, right? That's point number one. Point number two is the wealth tech markets, we said there's 500 and some odd companies, but a lot of them are not big enough to be public. These are small single point solutions with single digit millions of revenues, maybe double digit millions of revenues. And those are acquisition candidates. Those are not IPO candidates, right? So what you've seen is you've seen the InvestNets, the Orions, the SS&Cs, the Broadridges, the SEIs, all these firms being the acquirers of those undersized wealth tech companies. So as they get bigger, you'll see some of them go public, right? But I don't think the single point solutions get bigger. I think the platforms get bigger, and that's what ultimately goes public.
Do you see looking in your crystal ball for 2025, do you see a straight line just increase in the number of VC investments and the number of M&A and wealth tech go up, or will it plateau and go down at some point?
I actually think it goes higher. I think both go higher. Again, wealth tech is a hot area. Wealth management is one of the few growing areas in financial services. So, if you take broader financial services, a little bit broader than this podcast, but if you think about banking and payments and everything that you could invest in, payments has been hot for a long time. InsurTech had a little bit of a glimmer day. There's some compliance things that are interesting, but wealth management is certainly one of the hotter areas within broader fintech to invest in. So I think you'll keep seeing the venture capital money plow in. If the venture capital money plows in, those companies have to go somewhere they could fail. It's possible they fail, but if they don't fail, they're either going to be acquired, that's M&A, or they're going to go public. I think they're going to by and large be acquired. So you'll see a lot of venture capital come in, a lot of M&A come in. I would bet in 2025, so again, we'll make this prediction here, October 24th. I bet there is not a wealth tech IPO next year also, that we go a whole nother year and see another zero go up on the board for IPOs. So maybe in 2, 3, 4 years, maybe Bain will be turning InvestNet to go public or something like that, or Ryan will be going public or something, 2, 3, 4 years out. I don't think we see any next year is my guess.
So I could take the other side of that bet and say, yes, there will be an IPO next year. All I need is one to be right.
Yeah, it's not a bad bet. You might want to take that. Yeah.
Okay, I'm going to take that. All right. So let's wrap up with evolving products and services. So talk about alternatives. There's been a lot of talk about that. We get a lot of inbounds. We're seeing a lot of marketplaces coming in, and you're on the board of Halo Investing. We know those guys really well. Sora Finance, both relatively different kinds of alternatives. We're seeing lots of other companies, Arch, of course, you mentioned Case and iCapital, but there's lots more coming that all seem to think, like Opto Investments from Joe Lonsdale, they all seem to think there's another way to skin this cat and provide alternative investments for advisors. One question I asked Joe was like, if you're successful at this, every advisor can't have above average returns with alternatives if everyone's doing it. Right. At one point, are there too many alternatives? It's no longer alternative. It's the status quo.
Yeah. Okay. So there's a lot of things buried in there. So let me take 2 steps back. So one is, I think a very hot trend right now, Craig, is supermarkets of all products. Right. So just like I worked at Schwab 30 years ago, and we had mutual fund supermarkets, right? Today, you have alternative investment supermarkets like Case and ICAP, and you have annuity supermarkets like DPL. You have structured product supermarkets like Halo. Having a supermarket is the modern way of delivering, less biased or I'd like to say it's unbiased, but it's certainly less biased. Here's a choice, here's a calculator, here's how you can sort through these products and find the right one for you. So I think that's a super popular trend across all products. Within the alt space, you probably know the wealth management industry is dramatically under-allocated to alts, right? So the institutional world is about 23 or 24% in alts, and about 50% of their flows go into alts. The wealth management world is more like 11% in alts, but only 13 or 14% of its flows go into alts. So wealth management is ramping up its alts usage, but it's still extremely low. And even the ramped up level is pretty low, right? So we probably have a long way to go in the wealth management channel using alts, right? I think the the delivery mechanisms, like you said, Case, ICAP, you brought up Opto, and there must be 10 more of those, by the
Mhm.
way. So there's a whole bunch of these players trying to bring alts to the wealth management market. My guess is they all do fairly well. It's a good space to be in. I think advisors shift more to alts. I think at the end of the day, your fundamental question about when is it not an alt? I think that's actually where we're headed, because if you actually take this thing that we call alts, which by the way, I think is a horrible name when you think about it, there's really two things under the category of alts. There's private markets, meaning venture capital, private equity, private credit, everything to do with owning a private company, right? That's logical exposure for everyone, right? If you're going to own public stocks, public credit, why would you not also own private stocks and private credit? That seems intuitive to me, right? Whereas the hedge fund world does not seem as intuitive to me, right? You own stocks and bonds. Now, do you want to pay some manager 2 and 20 because he's a better stock and bond picker? I'm not sure I need to own that thing. I might just choose in the public arena to own cheap index funds or cheap index ETFs. But I do think everyone probably needs, not everyone, I think a lot of investors need exposure to the private market. So my guess is this thing we call alts today isn't called alts in 5 or 10 years, that we separate hedge funds from private markets. And private markets is just a core part of everyone's portfolio.
So 2 questions. Do you see enough business for, I guess the answer is yes, for all these alternative markets? Or is it all going to be snapped up by the big three, Case and iCapital, and probably Opto is in there? Then whatever Fidelity and Pershing and Schwab can offer they'll have alternative investments. And then the dregs are for everyone else. Or will this market explode and everyone's going to have a lot of business?
Yeah. So like almost every other wealth tech category, I think what happens is you have a couple players way out in front, right? I mean, my read from the outside is ICAP has a little better footprint in the wire channel, the more captive advisor channel. Case has a little better footprint in the independent advisor channel. I think they both survive and do thrivingly well. Then what you see is a whole bunch of other platforms. Sometimes there's single product platforms. So it's just access to venture capital, or it's access to art, or it's access to sports teams or something like that. I bet all those get snapped up by the broader platforms. So I think you'll see, again, I guess ICAP's made some acquisitions. In fairness, they've already made some. I'm not sure Case has made any. I can't remember any, but I bet you see them becoming big, aggressive acquirers a few years out, where any budding alts platform, they're taking them out. They're trying to take them out. Then I think someday the ICAPs and Cases either go public, that's possible, or a custodian buys them, like a Schwab or a Fidelity, or a TAMP buys them. If InvestNet or InvestCloud or one of these was in better financial health today, they'd probably be trying to own that alt space right now. So those are probably your 3 outcomes. But yeah, you'll still, just like in every other category, you'll see lots of wealth tech innovation in alts access. The big platforms will win. Then the big platforms will either go public or get taken out.
Chip, you've said it all, and we are out of time. I could have kept going another couple hours on this, but we'll have more talk. We'll have more time to talk at the next conference. But tell us when the next conference is and how people can find out more about Tiburon.
Okay, so the Tiburon CEO Summit, as you said earlier in the call today, Craig, is twice a year. So in the fall, we generally have a West Coast conference. This year is October 28, 29, and 30 in San Francisco at the Four Seasons Hotel there. It's kind of somewhat sentimental to me. I live in the Bay Area. We actually rent the ferry boat and bring people over to Tiburon for dinner. So it's kind of got that hometown feel for those of us who started Tiburon. In the spring, we have a summit on the East Coast. This year, it's in Boston, and that happens to be the exact same day. It's the 28th, 29th, 30th of April in Boston. So twice a year. Tiburon website is Tiburon Advisors, ORS. The word Tiburon is a town. For those of you that speak Spanish, the word Tiburon, if you say it correctly, is the word shark in Spanish. But Tiburon Advisors is our website, and you can sign up for the Tiburon Summit there.
Awesome. Chip, thanks so much for being here.
You got it. Thanks for having me, Craig.
Hey, it's Craig again. Here are my top 3 takeaways from this episode with Chip Roame. Number 1, wealth tech landscape. We talked about the 520 wealth tech companies that Tiburon has identified, which is slightly below the number of companies on the wealth tech map that Michael Kitsis and I work on. We've got about, I think, 553 companies on the map. Chip mentioned there were 315 VC investments in 2023 and 188 M&A transactions in 2023, but no wealth tech IPOs. Alternative investments. The wealth management space is woefully underallocated to alternatives, only 11% versus institutional investors, which are 23%. Chip identified a growing trend of supermarkets for alternative investments, such as Case and I Capital, Arch, Halo, other firms that are building these alternative supermarkets, and that he broke out a distinction between private markets, VCs, PEs, and private credit, and hedge funds. And finally, the wealth tech M&A outlook. Tiburon is expecting a continued high VC investment and M&A activity. Larger platforms likely to acquire niche and single product solutions, no surprise there. And there's potential for major wealth tech IPOs in the next 2 to 4 years, potentially Orion or InvestCloud. So you've heard it here first, and you made it to the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, please head to our website, ezragroup.com, and scroll to the bottom of the homepage and sign up for our newsletter. Once a month, you will receive an email chock full of wealth management goodness, news, information, updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.